video, I'm going to take you through some further examples of tax-based calculations. So remember the rules to calculate a temporary difference. We start with the carrying amount, subtract off the tax base at the year end, and we can think of that as if what's its value likely to be if there was a tax balance sheet being prepared, and the difference between what we have in our accounting records, the carrying amount, and its tax base is the temporary difference. And that arises because the item is recognised in a different period for accounting than when it's recognised for tax purposes. And remember that we will tell you what tax treatment to apply, as it will differ from country to country. The CSG explains the rules for determining whether a temporary difference gives rise to less tax in the future, a DTA, or more tax in the future, which results in a deferred tax liability being recognised. So try to keep these rules in mind when you're looking at calculating the tax base. Think about, will I be paying more or less tax in the future? So let's start looking at some examples. Firstly, I'm going to take you through some prepayments. And this may give rise to a temporary difference when the tax treatment differs to the timing of the accounting treatment. So we're looking at a prepayment asset. We've got a balance at 30 June X7 of $50,000. We've paid $50,000 more than what we've expensed for accounting purposes. So there's the journal entry we'd record. Now assume for tax purposes that the tax deduction arises when the amount is actually paid. Therefore, there's a $50,000 tax deduction now. However, when the amount is expensed for accounting in the future, there will be no tax deduction because we've already claimed it. This gives us a temporary difference because the expense for accounting and the tax deduction fall into different periods. Now let's assume that the tax rate is 30%. So applying some logic, we think about that we're going to be paying less tax now because we're getting that deduction up front. So we'll be needing to recognise a deferred tax liability. You might find that the best way to determine the tax base is to keep focused on whether there will be more or less tax to pay in the future. In this way, you can work backwards in a way with the tax base formula to get the logical result. To determine the tax base of an asset, we start with the carrying amount of $50,000 from the statement of financial position. We then subtract the future taxable amounts. This part's a bit of an odd concept when we're calculating the tax base of an asset. We assume that the future taxable amounts are equal to the accounting carrying amount. And lastly, there are no future deductible amounts to add because we've already claimed the tax deduction for these $50,000 in prepaid costs. Alternatively, you might find it easier to think of an imaginary tax balance sheet being prepared. Now, the $50,000 would not be recognised as the tax rules are following a cash basis in this case for prepayments. We get the deduction when the amount's paid. Therefore, the tax base of the prepayment is zero. Now, you can choose which way to think about your tax base calculation, whichever is easier for you to understand. Let's put this information into our formula to determine if the prepayment gives rise to more tax in the future, a DTL, or less tax in the future, a DTA. Let's work through the formula. So we calculated the carrying amount, that prepayment asset was $50,000, and we just saw that the tax base was zero. We apply those values into the top line of that formula there, and we see that we've got a taxable temporary difference of $50,000. And you can step back and think about this logically. We're getting the tax deduction now when the costs are paid, so we're paying less tax now. So there'll be more tax to pay in the future when the expense is recognised for accounting. This is because the accounting expenses will have to be added back when you're calculating the current tax liability, as they won't be deductible when you're calculating that taxable income for your current tax liability calculation. So that's why the prepayment creates a deferred tax liability. And here we can see that that's $15,000. Let's move on to another example where the temporary difference relates this time to a liability. So I've got accrued expenses, a liability account of $20,000 at 30 June 2007. This means we've expensed $20,000 more than has actually been paid. So that's what the journal entry would look like. Debit expense, credit accrued expenses. Now assume for tax purposes that the tax deduction arises for these particular expenses when the expense is paid in a later period. So we'll get a future tax deduction of $20,000 in the later period. So we have a temporary difference because the expense for accounting, look at our journal entry in that second bullet point, and the tax deduction fall into different periods. Again, let's assume the tax rate is 30%. Applying our logic, it sounds like a DTA, doesn't it? We're paying more tax now because that expense isn't deductible when we're calculating our current tax liability, but we'll get the deduction in the future. So what we want to see is the recognition of a deferred tax asset for this temporary difference. Again, let's have a look at our tax base calculation. So here, if we use the formula approach, we start with the carrying amount of that liability in our balance sheet of $20,000. We subtract the future deductible amounts of $20,000. When we actually pay those, we'll get the deduction. And we add on any future taxable amounts, which we assume to be zero in respect of a liability. Therefore, that means that the tax base of this liability is zero. Alternatively, you can apply the notional tax balance sheet approach. The tax base of the accrued expenses liability is zero. In an imaginary tax balance sheet, the $20,000 in accrued expenses would not be recognised, as the tax deduction only arises when the expenses are actually paid. So it's really following a cash basis there for tax purposes. So again, we can say that the tax base is zero. Either of those approaches is fine. So let's work out what sort of temporary difference we then have. So there's our formula that we apply in relation to a liability. So we can see those different approaches up the top depending on our values. Our liability has a carrying amount from our balance sheet of $20,000. The tax base we just calculated was zero. Therefore, we have a deductible temporary difference of $20,000. You can see we're applying that rule in red from our table from the CSG. A deductible temporary difference leads to a deferred tax asset. In this case, it's $6,000. So that's why the accrued expenses liability results in the recognition of a deferred tax asset. Now, it's probably a good idea to revisit the examples of tax base in your CSG to look for some examples where the tax base is a value other than zero, as we've seen in these two examples today. So where you've got a depreciating asset or trade receivables, you'll find that the tax base is something other than zero, but you still have a temporary difference. So perhaps pop back to the CSG now. Thanks for listening.